Welcome back to the Manor. Julian McBain here, and today we are back with personal finance for gamers. And we're going to be talking about some of the more interesting investment vehicles: mutual funds, real estate investment trusts, and hedge funds. But before we do that, I do want to remind everyone that Boneworks is now starting to be released in its syndicated form, of course. The first 2 episodes dropped this week. The first one should already be out, so please take the time to go watch that. It is my first truly edited video. Halo content will be forthcoming in the near future. As I'm burning through college, I need a way to blow off steam, and let me tell you, Halo Infinite's a fantastic way to blow off steam, so I figured I'll just turn on the recorder, I trim out the loading screens, and I post those up because, hey, easy content. May not be as entertaining or as informative as okay, it's probably more entertaining, but it's far less informative as this, but it is fun. So, beyond that, before we get into the content, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We are on the road to 13 million subscribers, 1 subscription at a time, so make sure you subscribe. Subscribe. Also, please consider going to patreon.com/JulianMcBain if you want to support my work. If you do, you'll get exclusive content. It is the patronage of my patrons that help me to produce all this content. It allowed me to buy the film editing software that allowed me to do the Boneworks series and do the Halo series that I'm working on. It was patronage that purchased Champions of Norrath, which is the game I'm playing. Assuming I didn't, hurl the disc outside after failing to kill that boss again. I'm making that content tomorrow. So, if you enjoy my work, please consider becoming a patron. I only have a $5 tier. Every little bit helps, but only if you think it's worth it. Okay. Let's talk about the fun stuff. First off, mutual funds. It's like, well, what's a mutual fund? You hear about mutual funds. Everyone talks about mutual funds. No one knows what the hell a mutual fund is. Well, a mutual fund is an investment company. It is a company formed to invest in other companies that then sells its own stocks on the open market for investors like you. The investor in the mutual fund owns an undivided interest in all of the underlying stocks. So basically what happens is you give your money to the mutual fund. The mutual fund invests it in other stocks. It is managed by a professional investment advisor and a board of directors whose job it is to make sure the fund achieves its stated goals. And it has various ones. We'll get into that in a minute. One more. Allergies are a bitch. So long as it continues to do so, the mutual fund makes money, you make money. They then take all the dividends and capital gains over the course of the dividend period, usually a quarter, divided by the number of mutual fund shares, and you get your dividends. The benefits to mutual funds: good for small dollar investors, automatically diversified. You get your dividends. Oftentimes you can automatically reinvest with no additional fees. They are easy to invest and forget. That's kind of the point of a mutual fund. Invest and forget. You do it by a drip, which we discussed in an earlier video, so that the dividends automatically reinvest. You invest $50 extra a month. That purchases in. And that's a good way to save for retirement. In fact, all your 401ks, all mutual funds of one sort or another, except if there's an ESOP, an employee stock purchase plan, which is called an ESOP. I don't remember what the O stands for, but basically it's you purchasing company stock in your 401 or your IRA. It's always a 401 for that. But anyway, all the underlying things, all those like Target 2020 or whatever, or 2025s or whatever, those are all mutual funds. Every mutual fund has a stated investment goal. Sometimes it's aggressive, which means it's going to be highly volatile. They're going to be investing in more risky investments. Sometimes it's income. far less risky investments. Sometimes it's strictly bonds. The bond fund, only bonds. Or they might be foreign investments. Small cap, which is small companies. Large cap, which is large companies. Like all of the, or target funds, which is to get to retirement by that certain date. The further away the date is, the more volatile. As it comes closer, they change their portfolio to make it more conservative. So, I haven't dealt with allergies in like 2 weeks, and tonight it's just being an asshole to me. So I'm very sorry about that. So, the stock on a mutual fund is purchased directly from and redeemed directly to the fund itself. You do not trade these on the open markets. There are certain types of closed-end funds that do trade on the market. We're not going to get into those today. They work the same on the underlying side as a mutual fund, but there's a limited number of shares that they issue. You trade them on the open market. Everything else works the same. So there, I actually just got into it. They're often called ETFs, exchange-traded funds. Difference is, they have a limited number of shares they'll ever issue. They never issue more shares, and their value goes up and down on the market. With mutual funds, their value goes up and down based on the value of the underlying securities. So, if you have, what they do is they take the total value of the securities the fund owns, they divide it by the number of fund shares. That's the cost per fund share. Also, they can only be traded at the end of the business day, which means if you put in an order, so this is something about buying securities. When you put in an order to buy securities, that does not mean you bought the securities right this second. You put in a purchase order for the security. Then, at the next trading window, your investment advisor will go and purchase the security, generally on the New York Stock Exchange, but it might be elsewhere, like the NASDAQ. But they'll go and they'll buy it, and then it's added to your portfolio when they manage to buy the stock. The investment advisor is permitted to choose when throughout the day the stock is purchased in order to try to advantage you on minute stock price changes. Because if you're buying a block of 100 shares of stock and they notice it dips by $3, you're going to save a substantial amount of money buying it when it's low for the day rather than when it's high for the day. But they do not have discretion on whether or not they make that purchase. Mutual funds work differently. Mutual funds can only be purchased after the tally of the day is up. So, when you go to purchase your mutual fund, you say you want 100 shares of XYZ fund. Your investment advisor gets the purchase order, and then they submits the purchase order to the mutual fund, and then the mutual fund waits till the end of the day. They calculate the value of their investment, and then you purchase those shares based on the value of the share at the end of the day. Theoretically, they could calculate it once per day at any time during the day. In practice, it's always at market close. Okay. And then, other than that, they work just like a regular stock. They pay their interest and they pay their dividends out 4 times a year, based on the capital gains and dividend or interest earnings of the fund itself. There are 2 ways that a fund can be managed. It can be actively managed or it can be passively managed. Actively managed funds have higher fees. On the other hand, they're more aggressively managed so that the fund achieves its goals. That means there's going to be more trades, there's going to be more costs involved, but the chance of a higher return is somewhat higher than a passively managed. Passively managed funds select a target, and they oftentimes it's like they're called index funds usually. They index the underlying shares to what is on, say, the S&P 500. So, and they try to match the performance of the S&P 500. This isn't the only index fund or the only passively managed fund, but it's the most commonly known one, and it's one I personally really like. Back when I used retirement funds as a vehicle, unfortunately, I ended up having to offload my retirement funds in order to move back to Vermont. But the index fund, it always matches the market, or it strives to match the market. Passively managed, so you don't pay nearly as many fees. It's a great investment vehicle. That doesn't mean it's the correct one for you. Please consult an investment advisor. Once again, this is not financial advice. This is merely educational. And these are my opinions. I am a guy on the internet. I no longer hold an investment advisor representative license. I am not providing investment advice, ever. Okay. So those are mutual funds in a nutshell. Real estate investment trusts. These are an interesting instrument. Far less common than mutual funds or other regular stocks. Although they're becoming more well known thanks to Grant Cardone. What a REIT, a real estate investment trust, REIT, often pronounced REIT, not RE. That's what we do when we snap our controllers in frustration at first-person shooters. REIT. A REIT invests in real estate. Most of the time, it's physical real estate. So, a couple of ways they might do it. They might purchase apartment buildings. They collect the rents through a real estate management company. You get the dividends based upon the earnings of the buildings that the REIT owns. So it might have, $2 million in apartment buildings, say 50 units. Those 50 units produce $50,000 in rent a year. The costs on it might be 20%, so there's $30,000. $30,000 is split between all of the members of the real estate investment trust, the shareholders in the REIT, or the people with certificates of beneficial interest. I cannot remember how that security is titled. I think it's the latter. And they're professionally managed so that you don't have to worry about whether or not the buildings are kept up. And it's just like owning real estate without having all the crap to go with it. Of course, the REIT is controlled by a board of directors. They actually choose which ones to invest in. Other ones are you could buy into a REIT whose goal is to build buildings and then sell them, and then you get a return on investment based on the sale price of the building. So they buy a piece of property for $1 million. They build a building for another $1 million. That's all the investment dollars that got put in. Then they sell the building for $4 million. $2 million pays back all of the debt or whatever was used to purchase the property and build it. The other $2 million gets divvied up among the REIT members. Sometimes that means that the REIT closes. Other time, at least I believe this was the case more than 10 years. When I got this license back, or the license as an investment advisor representative license, it's been a hot minute since I've really dug into REITs of this nature. But generally speaking, they'll then take the profit and they'll start over again and continue rolling that over. Oh, shit. I keep forgetting to repair my attachments. So, those are REITs. Again, REITs are a fantastic vehicle. Please check on the prospectus for the REIT if you're looking at it. Talk to an investment advisor. The benefit to REITs is that they invest in hard assets. The downside to REITs is they invest in hard assets. It's that simple. Just like investing by buying land. It's great because it's a hard asset that will never be worth zero. The downside is that it's a hard asset that's really hard to offload, generally speaking. Not in today's market, apparently, but overall, it's harder to offload than simply, it's not liquid. You can't just go, oh, I don't need this piece of land anymore. I'm gonna put in a sell order, and someone that's nice is just gonna buy it. That doesn't happen. You got to go through a realtor, and you have to do all of that stuff, and it usually takes weeks or months rather than hours. REITs kind of solve that issue, but they themselves have that issue. So there's that balancing act. So that's a REIT. Now let's talk about something really fun to talk about. Hedge funds. And what is a hedge fund? Hedge funds are generally organized as general partnerships. If you aren't familiar with corporate law, I encourage you to go look at the different formations of companies. Most people know partnerships from law firms. Hedge funds are designed the same way. The investment advisor is the general partner. The other partners are limited partners, which means they can only lose their investment. To invest in a hedge fund, you must be an accredited investor. What is an accredited investor and how do you become one? Well, you have to have $1 million in assets, net worth, I should say, $1 million in net worth, and your primary residence don't count. So you have to have $1 million in assets. You have to have $1 million over the total amount of debt you have. Your mortgage only counts if the mortgage value is more than the value of the home. Otherwise, both the home and the mortgage are completely discounted on overall. Or you personally can have $200,000 in income for more than the last 2 years with the expectation that it'll continue. Or if you are married, $300,000 with your spouse for more than 2 years with the expectation of similar or higher income in the future. Or you can have the Series 7, Series 65, or Series 82 registrations. Fun fact, when I had the 65, that was not considered an accredited investor qualification. I'm really sad. Not that it would have mattered because no hedge fund would look at me, but there are private placements. Being an accredited investor comes with other benefits. Like there are certain private placement investments you can only invest in if you're an accredited investor. So, okay, what is a hedge fund? Hedge funds are a bunch of rich folk that get together, pool in several $1 million a piece, and say, invest in the absolute riskiest shit you can think of. And you think I'm joking, I'm not. The reason hedge funds are known for making so much dough is because they're basically gambling funds for rich folks. They'll invest in good stable stuff, although their primary investment advisor does most of that. But what they'll do is they'll invest in high yield bonds. They'll invest in really risky companies. They'll invest in foreign investments. They'll invest in stuff that could go completely upside down. They invest in GameStop. And then they do what is called hedging, hence the name, by buying things called derivatives, also known as options. I'm not sure how much into these I'm going to get into in this series. But basically, they use calls and puts where they can call a stock at a fixed price, even if it's valuated above that price, so they can then resell it immediately for a profit. Or puts, which is they sell a put to someone, or they buy a put from someone, saying that they will sell the stock to them at a fixed price, even if the price of the value of the stock is below that price. Yes, below that price, therefore preventing them from losing money. This is often done by borrowing stock from people, selling the stock with a bet that it's going to go up or down. So if I borrow the stock from Joe and I sell the stock for $100 a share at 100 shares, that's $10,000, right? But I still owe Joe 100 shares of that stock, XYZ company. So I buy a call. And with that call, I pay $50. I can now purchase the stock back from you at this fixed amount in the event the stock goes down instead of up. I think it's going to go up. Cool, right? So, bought this call. Stock goes up. I call the stock at $110. I give Joe his stock back, and I've made $1,000. See how that works? Did I do that backward? No, because if the stock goes up, you call it back for a lower price. Yeah. I might have gotten the details on that screwed up. I should have thought that through a little more. Options are not my strong suit. Options are not my strong suit. But that's the idea. I may have screwed up the details. Mea culpa if I did. Talk to a financial advisor about options if you want to trade options. They're a headache to me, which is why I never really got into them. But they are there. That's what hedge funds do. That's their bread and butter. They just hedge the shit out of everything. And so that's how they make money. And they make risky bets, and they hedge their bets, and they make shitloads of money off of it until someone gets the brain trust idea to purchase more shares of a stock than actually exist, or purchase calls on stock, more stocks that actually, not calls. I think they were shorting it, so they're buying puts. Purchase more puts on a stock that actually exists, and then when the people who own the stock say, "We're not selling you the stock, so you can put it on someone else," sorry, your whole hedge fund goes. So, oops. I'm just an ape. So yeah, that's what a hedge fund is. Hedge funds, by their nature, are not evil. They just are what they are. That being said, they are strictly there for the rich because they are doing stuff that the average investor should not be doing. Because you could lose everything, and they sometimes do. And by everything, millions of dollars that they put in these funds. Millions per person. Which is why the average investor can't invest in hedge funds. Because you put $1,000 in, that's your life savings. You're thinking, I'm going to make all this extra money, and then, you know, a bunch of apes get a hold of things. So, that's what a hedge fund is. If you're an accredited investor, if you meet the criteria for an accredited investor, they might be a good option for you. If you trust the other people in the fund, there are a lot of limitations to hedge funds. So invest at your own risk, especially since hedge funds are not subject to any scrutiny really whatsoever, because you're all accredited. If you have that much money, you should know how to handle your finances at that point, or you won the lottery. If you win the lottery, for Christ's sake, sit down with an investment advisor. Because yeah, now you're technically an accredited investor, but you don't have all the background of someone who either A, worked it from the ground up, or is from generational wealth where half your education is how to manage money. And that's why rich families stay rich, by the way. They have family offices that are just there to manage finances. They're there, half their kids' education is, I built this family's finances from the ground up. You will not screw it up. Here is how the money gets managed, and these are the people that you need to listen to. In exchange for making sure we stay rich, we pay them a shitload of money, and they stay rich. It's one big corrupt family. It's not truly corruption in that state because you're not involving politics, but that's how corruption actually happens. I strongly recommend watching CGP Gray's Rules for Rulers and Death and Dynasties if you really want to get into that whole thing. But for now, thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, I really appreciate your support. Huge shout out to my patrons. And you all can't talk tonight. We'll see you in the next one.